February 16, 2026. 10:02 a.m. Eastern Standard Time. In less than 2 minutes, 74 million ounces of paper silver were dumped into the futures market. The price fell from $78.40 to nearly $76.15 in about 8 minutes. A violent move. A sudden move. The kind of move that looks like panic. But here's the part almost no one talked about. Not a single ounce of physical silver changed hands. And this happened just 22 hours before the U.S. Consumer Price Index inflation data was scheduled to be released. If that sounds like coincidence, stay with me. Before we go deeper, let me say this quickly. A lot of time, research, and effort goes into breaking these events down in a way that actually makes sense. If you value serious financial analysis, not hype, not noise, take a second and subscribe. It genuinely helps the channel grow and keeps this kind of content coming. Now let's get into what really happened. At exactly 10:02 a.m., during one of the most liquid periods of New York trading, an abnormal surge of sell orders hit the COMEX Silver Futures Exchange. In a typical 10 a.m. hour, around 800 silver contracts trade. That's normal. That's baseline activity. But between 10:02 and 10:04 a.m., approximately 14,847 contracts were sold into the market. Each contract represents 5,000 ounces of silver. Multiply that out and you get 74,235,000 ounces. Over 74 million ounces dumped in 120 seconds. To put that in perspective, global silver mine production in 2025 was roughly 830 million ounces for the entire year. What hit the market in 2 minutes represented nearly 9% of annual global production, at least on paper. In dollar terms, that sell pressure equaled about $5.7 billion in notional value. Meanwhile, the entire global silver market across futures, ETFs, physical transactions, and spot markets averages roughly $3 billion in daily trading volume. So someone dropped nearly double the normal global daily volume into a 2-minute window. That's not gradual liquidation. That's not portfolio rebalancing. That's an execution designed for maximum impact and minimum time. Silver fell $2.25 per ounce almost instantly, a 2.9% drop in minutes. Algorithms triggered. Stop-loss orders cascaded. Momentum traders exited. The price chart looked like a cliff. And yet, while the paper market was collapsing, something very different was happening in the physical market. Dealers across North America and Europe reported heavy buying. Websites slowed. Phone lines lit up. Physical buyers were stepping in aggressively. Premiums did not collapse. Inventory did not flood the market. Instead of sellers appearing everywhere, there were buyers, real buyers, wanting actual metal. That divergence matters. When a genuine market collapse happens, both paper and physical markets move together. Sellers show up on both sides. Premiums shrink. Dealers struggle to move inventory. None of that occurred. What we saw instead was a technical paper event that overwhelmed price discovery while physical demand remained strong. Now consider the timing. February 17th at 8:30 a.m. Eastern Time, the Bureau of Labor Statistics was scheduled to release January CPI data. Analysts were expecting core CPI around 0.4% month-over-month, about 4.8% annualized. Headline CPI estimates were closer to 0.5% monthly and 3.7% year-over-year. Both figures well above the Federal Reserve's 2% target. Historically, when inflation data comes in hot, precious metals respond positively. Gold and silver tend to rise as investors seek protection against currency erosion. That's not theory. That's decades of observed market behavior. Institutional desks understand it. Commercial banks understand it. Hedge funds understand it. So ask the obvious question. Why would silver experience a sudden, concentrated crash 22 hours before inflation data that was widely expected to be $-? Why would aggressive selling appear precisely when rational positioning would suggest the opposite? To answer that, we have to understand how the modern silver market actually functions. A COMEX silver futures contract represents 5,000 ounces of silver. In theory, when someone buys a contract, they are agreeing to take delivery of 5,000 ounces at a future date. When someone sells, they are agreeing to deliver it. In practice, less than 1% of futures contracts ever result in physical delivery. Almost all contracts are closed out or cash settled before expiration. That means something very important. You do not need to own physical silver to sell a futures contract. You only need sufficient margin capital to maintain the position. In other words, paper silver can be created in enormous quantities without direct linkage to physical supply. Total above-ground silver inventory suitable for investment is estimated around 3 billion ounces. Yet daily paper trading volume often represents 200 to 300 million ounces. Over a month, paper volume can exceed total annual mine production multiple times over. The leverage between paper claims and physical metal is massive. Imagine a casino where one physical dice sits on a table, but 100,000 people are allowed to bet on that single roll. Eventually, the volume of bets becomes disconnected from the object itself. The bets drive the system more than the dice. That's the structure we're dealing with. On February 16, whoever executed that 14,847 contract sell order didn't need 74 million ounces sitting in a vault. They needed margin and conviction that price could be forced lower, at least temporarily. When massive paper selling hits in a tight window, it pushes price down. That triggers automated stop losses. That creates additional selling. Additional selling accelerates the drop. And throughout the entire cascade, physical supply remains unchanged. Now consider positioning. Major commercial banks often hold large short positions in silver futures. A short position profits when price declines. If you're short and you anticipate inflation data that could push silver higher, there's an incentive to reduce exposure beforehand. A sharp engineered decline allows shorts to cover at lower prices. Sequence matters. Build short exposure over weeks. Identify a high-impact macro catalyst. Execute concentrated paper selling into liquidity. Trigger stops. Force liquidation. Close shorts into weakness. Profit. This is not a theory about emotion. It's a mechanical explanation of incentives and structure. But this story runs deeper than one trading session. To understand why silver suppression allegations persist decade after decade, you have to zoom out to 1971. Before August 15, 1971, the US dollar was convertible into gold at $35 per ounce under the Bretton Woods system. When President Richard Nixon closed the gold window, the dollar became fully fiat, backed not by metal, but by confidence. For over 50 years, the global monetary system has operated on that foundation. Confidence in currency stability. Confidence in central bank policy. Confidence in controlled inflation. Precious metals complicate that narrative. When gold and silver rise sharply during periods of monetary expansion, they send a signal. That signal suggests currency debasement. It suggests inflation risk. It suggests diminishing purchasing power. By early 2026, official inflation had already remained stubbornly elevated. Core inflation above 4% annually. Food prices up roughly 23% since 2020. Housing affordability near 4-decade lows. Energy volatility persistent. The average household could feel the squeeze. If silver had broken decisively above $80 ahead of CPI, the psychological effect would have mattered. Financial media would have paired rising metals with rising inflation. The narrative would have reinforced itself. Confidence is subtle, but it's powerful. Now add another layer. The derivative exposure in precious metals markets is enormous. Commercial banks hold billions in notional short positions. If physical delivery demands ever overwhelmed available supply, if paper claims diverged too aggressively from vault inventory, short squeezes could generate serious systemic stress. Silver suppression, from this perspective, is less about metal and more about currency credibility. An uncontrolled precious metals surge during persistent inflation would challenge central bank narratives directly. For business owners and entrepreneurs, this isn't abstract. Working capital sits in dollars. Contracts are denominated in dollars. Debt is priced in dollars. If currency confidence erodes rapidly, planning becomes difficult. Pricing models destabilize. Preservation of purchasing power becomes strategic, not theoretical. So what does a rational operator do in a system like this? First, accept structural reality. Individual participants cannot reform COMEX mechanics or central bank policy, but they can control allocation. Physical ownership becomes different from paper exposure. Futures contracts and ETFs operate inside the same financial plumbing that allows massive paper leverage. Physical silver held directly cannot be margin called or algorithmically liquidated. The paper price may fluctuate, but the ounces remain. Allocation size matters. Precious metals function best as insurance rather than speculation. Many strategic advisors suggest 5 to 15% of liquid assets as a balanced range. Enough to hedge currency risk, not so much that volatility disrupts operations. Second, accumulation strategy matters. Sharp paper crashes like February 16th often create opportunities. Dollar cost averaging smooths volatility. Buying fixed amounts over time reduces emotional decision-making and ensures participation during artificially suppressed periods. Third, understand premiums. A $76 futures quote is irrelevant if physical silver costs $82 due to demand. The real transaction price includes premiums. During heavy physical buying, the spread between paper and physical widens. That divergence is information. Fourth, diversify beyond one hedge. Productive businesses with pricing power. Real estate in constrained markets. International diversification. Tangible assets with intrinsic demand. The goal is resilience, not dramatic gains. And finally, patience. Market structures like this don't unwind overnight. Paper leverage can persist for years. Manipulation, whether you call it suppression, stabilization, or strategic liquidity management, can last longer than traders expect. But structural imbalances do not disappear forever. If paper claims continually exceed physical availability, tension builds. At some point, delivery stress, geopolitical shifts, or monetary instability could force repricing. When that happens, price discovery may look very different from the tightly controlled sessions we see today. February 16, 2026 was not just an 8-minute drop. It was a case study. 74 million ounces sold on paper. A 2.9% decline in minutes. Physical buyers stepping in while futures collapsed. Timing aligned precisely before inflation data.